I prepared a list of standards issued and not yet operative, can act as a checklist for your 30th of June accounts. And as you can see, there are a fair number of those particular accounting standards. Now, what I don't want you to do as preparers is to list all those accounting standards. You're not required to list all those accounting standards. You're only required to list and provide a discussion on those accounting standards that are relevant to you. And we review hundreds of sets of financial statements for accounting firms and others every reporting period. And I've got to say that you as preparers don't do a really good job at the issues and not the operative. We're into being efficient, and sometimes that efficiency means you grab a note from a model set of accounts and just plop that in as our issue and not the operative. That is not the way you do these disclosures. Yes, you need a starting point to see what the standards are, because only us colour heads know what the issues, not the operative standards are. I expect you to know them off the top of your head. So you need a list to start with, and then you see which ones are relevant to your business, and you make the disclosures about those particular accounting standards. And the rules sort of go like this. The closer you get to the date of implementation of those accounting standards, the more you should know about the level of detail. So if I flip it around the other way, if an accounting standard is issued in May and you're a June balancer, I don't expect you to have made an assessment of that particular accounting standard because it's just been issued. So I expect the discussion to be, we have not yet made an analysis of this accounting standard. But once we get into the comparative period, and remember, normally the rules in relation to comparative period is that at the start of that comparative period, I've done a third balance sheet because I'm required to do that under WSB 101. Then I should be able to give some real directions to users of accounts about the effect of that particular accounting standard. While I might not be able to put some numbers around those standards, I can at least tell users what the effect is. And probably the best example of that is the leasing standard, because under our existing standards, we have to disclose in the financial statement notes our commitments to operating leases. So as a surrogate for the new standard, I can at least say, well, look, under AASB 16, we're going to recognise operating leases as a right to use. And based upon our existing disclosures of operating leases at $15 million, we are going to recognise an asset and a liability in the vicinity of this amount. So you're telling the users of accounts two things there. One, that you've got an asset right to use, a liability that's going to be reflected in the accounts. And secondly, you're going to be able to put a qualification around those. So this 30th of June reporting period is, because it is the comparative period for the 30th of June reporting balances, I have the expectation of you as preparers that you will be able to give a description of the effect of the new accounting standards on revenue and financial instruments, and also leases. Leases are a year off, but I think it's intuitively you can provide some numbers. Also in relation to revenue and financial instruments. Just on financial instruments, the key issue to my mind is the impairment of your receivables in particular. The impairment of receivables is recognised at the time you enter into the receivable and make some estimates about what your expectation is about the recovery of those receivables. So the provisions for doubtful debts, both general and specific, one would be larger and recognised at an earlier time. So you can give some indications of what the effect is on these standards. The listed entities, and I know that there are a number of you in the audience, I make this point very strongly. Having been involved in a number of class actions for breaches of continuous disclosure, it is very important for you, once you identify the impact of these accounting standards, to make the disclosure to the marketplace. The revenue standard will almost invariably result in deferral of revenue. And revenue is a key number in the marketplace. So once you've made your assessments, make the disclosures to the marketplace. Because you don't want to fall foul of those that will use the lack of disclosure to launch a class action.
Sorry, can I just pull you back to that point?
Please. I love interaction. Well done.
So, if it's going to be, like, if we're assessing deferral of revenue based on standard, wouldn't that ultimately really be signed off by the board, probably at the same time that the financial statements are signed off? And so you disclose it with the financial statements at the same time, like when you do the note?
I normally lead with my chin. I'm glad that you all led with your chin there too. I would expect that if we look at the new accounting standards, that these issues would be permeating right throughout the reporting period, and there would be some reporting to the Audit and Risk Committee about what the dimensions of the accounting standard are. So once you know what the effect of that accounting standard is, and if it does in your assessment have a material impact on revenue, you're obliged to make that disclosure at that point in time. So you as a listed entity will have some policies and procedures around when you make continuous disclosures. So you refer to that policy and procedure. It's probably been vetted by your lawyers at the end of the day. And if I turn that into an example, just say in March, I'm getting ready for the end of the year, I've got my accounting policy, I know the effect of that, but the board isn't meeting until June. I just can't sit on that for that period of time. You've got to make the announcement then if it meets the requirements of the continuous disclosure regime. Now, there are numerous examples on the ASIC website where they've taken action against entities for not making continuous disclosure of these Collins terms immediately. There's been infringement notices, minor infringement notices, 60,000, bigger infringement notices, 300,000. To my mind, that's an ASIC penalty. My real concern is with...
to be fair, historically they've been where the continuous disclosure breaches have been as a result of a change in trading conditions or a loss of a contract or something like that, not over an accounting standard change that hasn't been signed off by the board yet. Do you know what I mean? Like,
yeah.
There is a difference between the two, I think.
I'm glad you think so. I see it differently, and I expect differences of opinion. But I would suggest that at a minimum, revenue being such a key number for analysts and the like, I'd be wary of not seeking legal advice in that space.
Would we be looking to have audit sign off the new revenue number? Like the revised revenue number, wouldn't we be looking for an audit sign off of that prior to going to the market?
There are two issues there. Audit sign-off will come with the financial statements. You, under the continuous disclosure requirements, should be making that announcement without audit sign-off. It doesn't require audit sign-off. So if you're, just say you determine what the amount was on 1st of May, and you said, part of our procedures is to get Paul Chadwick in and for them to provide some comfort on that number, but that was going to take another 2 weeks. You run a real risk of non-timely disclosure. But all good questions, and I'm sure that if you had those, and others in the audience did, I look at all the continuous disclosure breaches that ASIC pursues. Also, there is a number of class actions because we get involved with audits in this space as consultant and independent experts. So I get to see many parts of that Rubik's Cube. So if I've placed a thought in your head that you at least have to perhaps have some discussion, now I might be right. Might be wrong. It doesn't matter if I'm right or wrong. It matters that there's an issue that you go to and pull it apart and come to a conclusion. Big, great stuff. Thank you. We have an interpretation issued by the International Accounting Standards Board. And as you know, we pick up international accounting standards, and frankly here in Australia we do the same interpretations. This was an interpretation issued last year, and while we'll talk about it more once we get to 2018, 19 when it becomes operative, it is on the list of issued not yet operative, so you've got to be aware of its existence. So the key issue is if you have tax is a complicated area and there are various interpretations, a number of entities may well engage in what could be classed as aggressive tax treatments to minimise what they consider lawfully to be minimisation rather than avoidance. And so that particular tax treatment can create some uncertainty as to whether or not the correct income tax expense, deferred tax asset, and deferred tax liability are appropriately stated in accordance with accounting standards. Because AASB 112 income taxes doesn't really address uncertainty over income tax treatments. We've got some general standards that deal with estimates and judgments, but when it comes to tax, that's a relatively sort of no-go area. Because we sort of stay mum on those particular issues because we don't want to work the tax office. In the local regime, we can see that the ATO is challenging a number of multinationals, in particular about their tax treatments. So the accounting standard interpretation basically says we're going to need you to view these uncertain tax treatments through the lens as follows. First of all, I've got to assume that the ATO has access to all the documents that I have and would make a decision based upon those documents. Now that is a very interesting proposition in itself. The second part is it probable that the ATO would agree with my position. So you're going to need some arguments as to why the ATO would, and most probably have the advisors on tax accountant or lawyer in that respect. Now, if it's not probable that the ATO will agree with your assessment, then you have to make a determination as to what is the most likely outcome of that dispute and adjust your income tax balances accordingly. So in that little nutshell of in that summation, I've posed a number of issues for you. So if you have a tax dispute, an uncertain over the tax treatment in your 30th June accounts, then this interpretation would require you to make some comment in relation to an issue and not the operative. Again, if I can turn it back to the issue of continuous disclosure, that might be really sensitive market information that you might at least like to through the prism for the appropriate accounting treatment. So it's issued and not yet operative. Again, if the entity had conducted an assessment and made some preliminary determinations in that space, then I would expect that those disclosures would be made over the issue and not be operative the side of the issue of continuous disclosure. Again, my good friends here at Chadwick, if they saw in the papers going to the Audit and Risk Committee or in board minutes or in some other form that you had done an analysis of these issues, but in your issue not yet operative said that you hadn't started an analysis and there was evidence to the contrary, they would have to challenge you on that. And the words might then change to say we are conducting an analysis of this interpretation and have not reached a conclusion.
It's very important. If suppose you make a policy today as per the tax law of this country or any country, and you make a decision on a long-term basis, every government is changing the law as they go.
That they do.
For a corporation who's got presence in a number of countries, how they will do it? Every country wants their part of the share, but they do not really understand what their part. It's getting into a nightmare where nobody knows what to do.
And that's a good rundown of where we are on some of the international tax sharing and the like. Where we get to on this interpretation is that I guess my words would be we're going to see increased transparency in the financial statements about what the issues are. Secondly, we're going to have probably a reassessment of what our tax numbers are at the end of the day. They might well change because this standard takes me into an area where if the tax office is not going to agree with my probability assessment, then I've got to have what is likely to be their view of these issues, accounting for estimates in the day.
So Ireland is a country that charges supposed 15% tax. And we decide to have a headquarters there and we can get the company tax there. And like we said, I'm going to pay here. And then Ireland is also charging, Australia is charging, America is charging, everywhere. Got to be, I think, an international body can define this basic set of rules that can really comply. Suppose Australia passes a lot tomorrow, I'm going to charge all your income worldwide here.
I hear what you're saying, and I like the idea. The issue, from my perspective, gets back to what are the requirements under this interpretation, and I want to put it on your agenda to ensure that you make the analysis and provide advice to the board, to your board. I just want to return back briefly to the issue to not yet operative, because I've got a couple of disclosures that I really want to press on you today, the importance of making these in relation to the new accounting standards. Why do we make these disclosures at the end of the day? We're trying to help users of financial statements understand the impact of new accounting standards on the statement of financial performance, statement of financial position, and cash flows. Because what we're trying to do with the accounting is try to provide information to users so as to help them predict future cash flows. So the issue to not yet operative disclosures are very, very important. So what do we have to disclose? I'll put it there in paragraph 30 of the standard. The fact that there is a change, the known or reasonably estimated. So it's not requiring a level of precision if you haven't got to that level of precision yet. But if you made a stab in the dark, as most CFOs would, because the board would be saying, well, there's new accounting standard, how is this going to affect us at the end of the day? If you said, well, it's going to result in some revenue deferral or a new asset or a new liability, the board would probably say, yeah, but give me a figure. And you might say, well, it's very complicated and the like, it'll take a long time to work out. Or we might say, yeah, we want that level of detail at point in time, give us a stat by tomorrow. So it's something that is reasonably estimated at the end of the day. And I know as accountants we like a real degree of precision in our numbers, but at the end of the day, financial reporting is forward estimates, and we should not be uncomfortable at making a reasonable stab at what a number is, as long as we're in the ballpark. So, what do we need? I'm in the relevant standards, getting back to the point that I made earlier that I wanted to reinforce. It is very important to look at those standards not just as at the 30th of June, but any new accounting standard or interpretation that is issued between June and the time that you sign off financially. So it's not just a standard as at 30th of June, you need to be alert to any new accounting standards that are coming through. I don't see any new accounting standards coming through between 30th of June and the time you sign off in August or September. So I had some tips for the CFO in terms of how we can improve the disclosures in the financial statements. So I think that they're self-evident, and of course the issue of our continuous disclosure requirements. Well, on the latter point, with one of the franchise chains, brokers report looked at the financial statements, saw a number of operating leases, hundreds of millions of dollars, put out a broker's report saying that these will go on balance sheet, and the share price dropped. I think it was 18 or 25%. I think it's 18% as a result of that broker's report. So people are interested in, the market is interested in the financial numbers. Suffice to say that that entity did have some other issues, and perhaps the progress report just fed on those other issues. I always like to have some examples at the end of the day, because, you know, I can talk about theory and the like. So some of you would say, it's like eating a hamburger, where's the meat at the end of the day? This example is EnviroCare, the funeral organisation. I'm watching them for a couple of years. Not because of their business model or anything like that, but because they provide one of the few entities that provides, to my mind, good disclosures in this space. They're also a 31 December balance date, so it gives me something more contemporary to create. So accounting for prepaid funeral contracts at the end of the day, under the new standard, the 10% fee that they receive at contract inception will be deferred, so, whereas previously it was recognised up front. Next part, commissions and directly related fulfilment costs will be capitalised in accordance with accounting standards. So this tells me two things. One, we have a deferment of revenue, so revenue is going to be down by some number. Market's interested in revenue numbers. Secondly, we have a new asset in the accounts, and not going to be amortising that asset over a period, and also that asset might be subject to impairment. So what's the impact? EnviroCare said, well, the third revenue will increase by 30.2 million. So a number, significant number. Deferred selling costs will increase by 20 million. And remember, most of these accounting changes have a deferred tax consequence. Deferred tax liabilities will decrease and retained earnings increase. That's very good disclosure on issues that not yet operative on prepaid costs. The next one, a bit more detail here. The nature of prepaid contracts generally results in a significant time delay, as one would expect with the nature of this particular business, between the payment and the delivery of the service, on average 15 years. So they've given us a time period. Good. As a result, a significant financing component is required. The revenue standard deals with that particular issue. And if we have a financing component, we will always have a discount issue to be considered. The discount rate applied results in revenue being recognised that approximates the selling price as if the customer had paid the consideration at the same time the services are provided. So, an explanation. All costs to deliver the service contract or memorial product will be expensed as incurred. So, a description of the issues. And then again, the impact of this particular change on the entity. And there are some more accounting issues not yet operating disclosure. What I like about this one is it is dealing with the key revenue line, so it's not just putting all of the disclosures into one. It is breaking them into those line items, so it's providing relevant information to users on the key business lines. It's fulsome in terms of it's entity specific, and they put some numbers around that a year before they apply the standard in full.